Hi there, Jim Hiles, your financial coach. We're talking about the principles of successful long-term investing. So let's go through principle number one, investing for the long term. Long term, what does that mean? Is that a week, a day, a month, a year, a couple years, a decade, a couple decades, lifetime? What are we talking about here? Usually you think long term, you're thinking more than 5 years, probably closer to 10 plus. And when you look at the reason why you have to think 10 plus, and by the way, think about that. Let's put that in perspective. If I'm which I was, a 45-year-old guy and I want to retire at 65, I've got 20 years to let that money work. And rather than trying to guess which way it's going to go on any given day, if I can just focus on this slide and say, look, markets can have a bad day, a week, a bad month, a year, but history suggests that investors are less likely to suffer losses over long periods. While 1 year stock returns have varied widely since 1950, they've gone up as high as 47%, they've gone down as much as negative 39% in any one given year. When you blend stocks and bonds together, this blend is actually what creates a diversified portfolio. In our particular example, all we're doing is a 60-40 blend. Well, you can see the relationship of stocks and bonds and what the returns have been over any 5-year rolling period in the past 69 years. So if you kept this thing in here, let's give you an example. So here's a 1 year performance. It can be as high as 47. This is stocks in the green, or as low as 39 in a given year. Could be a great year, could be a bad year. And this is what bonds have done in the last, since 1950. So you're looking at up 43%. Yeah, bonds can actually make a lot of money and bonds can actually lose money. So be careful of that. And then when you look at the 60-40, you're basically taking a blend of the two. So you don't go down as much, you don't go up as much. But on the other hand, over time, you take the stocks over 5-year rolling periods, every 5 years, averaging out over a rolling period, and you take those and you roll them forward through this entire history since 1950, you can see that in over 5-year periods, in 10-year periods, and 20-year periods. Let's focus on this 20-year for just a second. That says that stocks over that period of time have done an 11% average rate of return over 20 years. When you look at this rolling 20-year period, it's gone as high as 17 and as low as 6. I'm not going negative if I hold this thing in this 20-year rolling pattern. For bonds, I'm going as high as 12. I'm going as low as 1, but still not a negative. My average is about 5.8%. My blended portfolio, 60-40, the average return, interestingly, is about 9.3. And you're up 15 and you're down 5. So when I look at the relationships of each one of these stocks versus bonds versus this 60-40 blend of stocks and bonds, if I hold this over a long period of time, you do not see a negative rate of return on any of these assets. However, your comfort may be better suited to stocks, given your preference, or a blend or bonds. But just understand that if you buy and hold, generally, the longer you hold, the more of a likelihood, the higher probability that you're going to see a smoothing out of returns and the higher likelihood of having a positive performance. Anyway, Jim Hiles signing off for now, and that is our principle of long-term investing number one.